Hello everyone and welcome to another edition of Finance Friday. In our last edition we spoke about mortgagee insurance and how some home loan borrowers can use LMI, as it's called, to enter the property market when they haven't yet saved an entire 20% deposit, as is traditionally sought by lenders. This edition we're going to look at another alternative to mortgagee insurance. And that's where a family member pledges additional security in favour of the applicant's loan in order to negate the requirement for mortgagee insurance, which can be costly. This type of support is commonly provided by parents of the borrower, and hence why in the industry it's usually referred to as a family guarantee. But as a potential guarantor, you need to think carefully before you even consider taking the plunge. It's crucial to be aware of the implications for you as a guarantor if you do become involved. And we're going to cover off on 3 questions that you seriously should ask yourself in order to see if becoming a family guarantor is right for you. The first thing that you should be satisfied with is your ability as a guarantor to repay the loan in the event that the borrower or the applicant defaults. Now, defaults can be caused by many things, including sudden unemployment or inability to work due to a serious accident. Regardless of the cause, many types of guarantees will hold the guarantor responsible, and legally so, to ensure the mortgage is actually paid off. And it's this last point which is why many lenders themselves will even assess a guarantor's ability to repay the debt when considering a loan application that does involve a family guarantee. As such, it's always very advisable and sometimes mandatory that a family guarantor will need to seek and receive independent legal advice before they can enter into such an agreement. It's no secret that it can take a long time to save the traditional 20% deposit, when you're looking to enter the property market. That said, becoming a family guarantor or involving a family guarantee should never be considered the first option. And as we've pointed out, there's a number of factors that, if things don't go well, they can actually put the guarantor's own property and livelihood at risk. As an alternative to providing a guarantee, if you're in a position financially to contribute actual cash to the purchase, that is a very reasonable option to providing a guarantee. It allows you to provide that same sort of help without necessarily putting your own property at risk. There is, however, a downside. Including this, what you would call parental gift, if the applicant's overall deposit is still short of the 20% traditional threshold, the lender will quite often look to ensure that the borrower has at least come up with 5% genuine savings over a 3 to 6 month period. Now, this won't include any parental gift. So that's it with regard to family guarantees. And as always, if you've got any questions, please don't hesitate to send them through. So that's Finance Friday for another week, and until next time, have a great weekend.